G'day, this is the first in a series on investment in shares and specifically on improving your super returns. Now, when managing your retirement super, a lot of people now are forgetting about chasing the huge returns of the past by taking big risks. That's an approach and a strategy that I think has gone by the wayside since 2008 because people are realizing that asset prices aren't guaranteed to keep rising anymore as they perhaps did in the past. And a good part of this is because the global mindset towards debt is now moved to deleveraging. So there's been a wholesale shift in the way that people think about their assets and their accumulation of wealth. So investors are seeking a better balance between return and the protection of their capital for investment portfolios. Whereas in the past they weren't so concerned about protection of capital long term, they just assumed it would be there. So the focus now has shifted very much to be more on a steady increase in dividends and profits. And just a quick reminder, this is general advice only in this video series. Now, volatility is something that has become a part of the market landscape and it's going to continue into the future. And many people are really quite scared about volatility, but it can be an ally because the way that we make money is when prices move upwards. And so you can use volatility and turn it to your advantage in building wealth. So I'm encouraging investors to get on the front foot and really recognize that better returns are possible for no more risk than where investors are currently perhaps hiding out in various fixed interest alternatives. It's a pretty simple process, but it's one that really goes against our fundamental way that our brain is wired and the way that we're conditioned. A lot of investors have a tendency to want to sell when the prices go down, and they want to buy when prices have been going up for some time and maybe near a peak. So whilst it's a simple process, it's one that's not necessarily that easy to execute. Now let's have a look at some historical results. And investors that have in effect bought the index, if you like, in various ways in 2005 have effectively yielded zero capital gain. They would have gained some on dividends, but they've had no capital gain in 7 years. And most investment portfolios and retirement super funds closely track the index. So that's the kind of performance that they've been experiencing. Now you can improve that performance by understanding how to time the market, and an entry into the market at a pretty obvious time after the GFC in March of 2009 has returned around 25% at the index level. So that's certainly an improvement on zero capital gain. But to take that a step further, in fact a considerable step further, if you know how to buy really outstanding businesses when they're at value prices, you can do far, far better, really no matter when you bought them. So let's have a look at a couple of charts. This is the ASX 200 index, and you can see that the index now is at the same level that it was at in July 2005. So effectively no capital gains. And you can also see that buying in March of 2009 at least gave you a bit of an edge. So buying near the bottom once the market has turned certainly does give you an edge. But let's have a look at a couple of examples of buying some of the really high quality businesses that are around. The first one is a company called McMillan Shakespeare, and the second one we'll take a look at is Monadelphous Engineering, which has been one of the best performers from a financial perspective on the Australian stock market for more than a decade. This is the price chart on Monadelphous, and you can see here that the price has moved over the last 7 or 8 years from around $2.50 to currently be at around $20. Now I've indicated there are a couple of potential entry points which were where the stock represented good value and the market was not excessively overvalued. So you can see several entry opportunities around the $4 and $6 to $7 area. So you can see that understanding how to buy good businesses improves your return or your capital gains enormously. Now Monadelphous is also a company that provides very good dividend returns as well. Now, yes, the price suffered during the GFC, but look, it was only brief. It was only really down for about 3 or 4 months, and it rebounded again very strongly. And that's typical of these really good businesses. Now, this is McMillan Shakespeare, and they've probably got an even better trend going. They were less severely impacted during the GFC, and their prices moved from below $2 to now be at around about $12.50. So an equally very strong performer. Now, the great investors of the world just think differently about their share investing. They don't buy stocks like most people do. They go out and they buy great businesses. And as a consequence of that, they know that they've bought a great business at good value, and so it means that they don't have to fret about weekly price fluctuations like most people do. So just buying the big names, just buying the banks and BHP and stocks like that is really a terribly limiting strategy. And you can do so much better with an understanding about how to identify companies that have got a high level of consistent performance, what price represents value, and the ability to time your market entry. So to improve your super returns, the next couple of videos in the series is going to look at some of the detail of the how-to on improving super returns. Now, to gain access to this ongoing series, you can either visit my channel or go to our website, which is specialistshareeducation.com.au. So, look folks, you can do so much better than the mainstream without taking any more risks with your capital than what most people are trying to do in being very conservative. And it's just so critical that you take steps to protect you and your family's future by making investments work harder for you. And despite all the negativity out there, there are still wonderful investments available. And I'm going to be sharing my research and those opportunities with you. There's plenty of free information on our website, and so check in regularly, as I know I can assist you a great deal. Cheers.